ASMR type vibes. No, what is good, y'all? Welcome to the game. That's gonna be the title of this first video. Basically, it's gonna give a mile wide, inch deep type look on different types of events, as well as a little bit of vocabulary, so that way it can help out with future videos. The point of this goal is to hopefully be able to highlight some things that might interest you, maybe not interest you, and also let you know the things that I'm gonna be focusing on this channel, this page at the moment. I might add some other things I might talk about, like credit, or even tap a little bit more into real estate. But as for that stuff, I'm not the best at it. I honestly haven't done as much research as I should in order to actually try to teach people about it. So I'm just gonna let y'all know what I know, and also tell you about some of the stuff out there. Before we do begin, I do want to clear up something. People use trading and investing synonymously, not simultaneously, but they're actually very different, and it's important to know the difference. Trading is short-term gains. You're hoping to buy low, sell high, and in some type of ways, you can actually buy high and sell low and still make money off of that using leverage. But you do that a lot, rinse, repeat, and hopefully be able to make some gains over time. And this can either be extra money in your pocket, pay a bill, or even be your main source of income. So that's what some people do. You can also do an investing type style, which people will put money into something either periodically or all at once and just be able to hold that over time. And it's going to appreciate over time, so in the long run they'll be able to be good, well off in life. And the time frame is years and years, maybe even decades into the future. So that's what they look forward to. There's a lot of stuff that you could get into, so I'm just going to be talking about a few. But the main ones that I heard about or people might be interested in, so let's go and get started. The first one you've probably heard about, most people know about, is real estate. Most people have a home, or even live in an apartment, or live somewhere. Unless you're homeless, no, sorry. You actually should probably be looking for a home first before you start investing. But, you know, if you want to watch this video, watch this video. Real estate, I mean, obviously you can read from the slides, there's different types of it. And not only that, but if you were to get like into buying houses or properties, you can also do like wholesaling, flipping, you do long-term hold, you can do rentals, you can do a whole bunch of different shit when it comes to real estate. That's something that interests you, you could do that as well. Or if you know someone who's into it, you can ask them questions about that. Retirement accounts, I mean, I imagine a lot of people heard of them, 401k specifically with their jobs. Some will offer that, and they can be very beneficial. Also IRAs, which can be beneficial in people's circumstances. I'll be talking about long-term investing as well as, sorry, this is actually energy drink. I don't want anybody thinking I'm sipping that drink right now. Dipping on some scissors. Dipping on some scissors. Gotta be professional. Nah, but I'll talk more about those in probably the next couple of videos. It's gonna be in the series, but just the next couple of videos. Those could be self-managed, or they could be managed by a company or someone else, just depending on your preference. Alright, what if you're good at this or that, and maybe this interests you, you could actually manage your own commodities. You can read that off the screen. Bonds, for those who don't know, it's basically like lending your money to either the government or to a company, and basically over a period of time, whether it be 5 years, 10 years, 1 year, I don't know, it depends on the bond, and they'll give you interest back on that money that you loaned them. If the company can't pay you back, then they usually have something called a security-backed bond, and basically if they can't pay you back at the end of the duration of the bond, the contract, then they'll give you something improper, basically, to pay you back, since they couldn't give you the money. And if municipal is basically whenever you give money to the government through a bond, like you buy treasury bonds or something. If the government can't pay you back, more than likely means they defaulted, and you have bigger problems to worry about getting your money back. That's for sure. CDs is basically a bond, in my opinion, with a bank rather than what's called the institution with the government. Mutual funds, they're basically pools of money, so you and other people around, I won't say around the world, but people who can deposit money into this stuff to specific companies that qualify. You give it to basically a money manager. What they'll do is they'll trade it for you. They'll get their cut, and they also, the profits that they make, they'll give it to you back as well. Your money's locked in for a duration of time, just to give you a heads up. But at the end of the day, you know, someone else is trading for you, so you don't actually have to be involved in it. You could either take cash out at the end of the duration, or you could just keep your money in there, have it recycle over time, and hopefully accumulate more and more as you go. Most people don't consider insurance as an investment, but I do. I want to put it in there because I feel it honestly is important. So for those who don't have insurance, please do, because in the event that something does happen, which usually happens, and then people were like, oh shit, I should have got this, and now they do it. Just avoid the problem in general by just getting insurance to start off with. Forex. Oh, before I move on, insurance, you're speaking of that, treasuries and wills, it's important to look at the difference between the two, which fits you, and if you are worth, I don't want to make it seem like you're worthless if you don't, but if you have like a good amount of money, or assets I guess you'd say, it's important to go ahead and look into this, because in the event that something does happen to you, a lot of it's going to be lost in legal fees, lawyers, courts, and all that shit, so it's good to look out for that shit first to begin with. If you do have a good amount of money, or assets, or cars, chains, whatever you want to have. Cryptos, NFTs, I'll talk a little bit more about this in a little bit, as well as future videos. But cryptos are basically digital currencies. I'll skip Forex, but cryptocurrencies are basically digital currencies. Exchange your US dollar or whatever country you're in. I imagine you're in the US because I only got like 12 people following this page, but you're trading your money for crypto. Each serves a different purpose. NFTs, digital images, again, I'll talk more about them in a little bit, but some of them actually have really good purposes for the wealthy. As for the smaller ones, it's more of collectible stuff. Forex is exchanging your currency pairs. It's basically exchanging currency pairs. So if you go to a different country like India, Japan, or even Mexico, if you're a bean like me, you trade in US dollar for a different currency, and on the way back you trade that currency back in for US dollar. And if you notice, there's different rates each time you go. And it's interesting because these guys actually use leverage in order to make money off of those small moves. And sometimes it's really big moves, like when the peso crashed during the 90s. The peso. I know I'm Spanish, by the way. Not the best. I definitely am whitewashed, but you know, I can't speak. But yeah, that's what they'll do. As for stocks, I mean, there's shares. You can buy and sell options, which are contracts. Spreads is a specific way of options where you buy and sell specific contracts. Like simultaneously. Leaps, longer dated contract. ETFs is basically a basket of stocks that you can buy shares of, or even trade options on. So what we'll be focusing on this page, we'll be focusing on shares, options, and cryptos. So shares, again, like I talked about, is basically buying ownership of a company, and the percentage that you own other companies is considered a stake you have in a company. And it takes a lot of money in order to buy a significant amount of shares to be considered like a big time investor. Have a company talk to you and ask you shit, but if you get to that point, you know, all's well for you, shit. And what some companies do, usually the bigger ones that have like a lot of money on hand, they'll pay something called a dividend out, basically like interest or even like rewarding people for holding on to shares in the company over time. This has lower risk because you have a limited time on these. You can pass these on to even to your kids, and this is how like some wealthy families stay wealthy, because one, they have shares that they bought and accumulated over time. Not only that, they pay dividends out, so over time those dividends pay that money out. I mean, those stocks pay out the dividends, the money out, and they buy more shares with those dividends. So again, they just keep making bigger and bigger piles of money that they can make off of dividends eventually to where they could live off of that shit. So it's definitely something you could do with shares. Options, there's definitely higher risk, and this is actually how I blew my port up. Yeah, I'm negative now because of fucking options. They're conditional contracts, and basically they gain or lose money based off the stock that they follow. And the most simplest one is buying a call. When you expect the stock to go up, you buy a call. So you're basically paying a premium to open the contract, to have possession of the contract. And the call is basically whenever it increases in value if the stock goes up. And it's higher risk because a stock, normally if you buy a share, it's a 1-to-1 ratio. If it goes up $1, you gain $1. If it goes down $1, you lose $1. Or with contracts and options, it could range anywhere from $1 to $99 that you can make off of a $1 move, which sounds really good, but you can also lose a hell of a lot of money that way, and fast. Trust me. Most people flip this premium, so basically the premium is what you pay to open up the contract, or there's also something called selling options in which you get paid a premium in order to open up the contract. Yeah, but if you're a big time investor, well, mutual funds or even hedge funds, what they do is they actually exercise the contracts. And what you could do is basically, let's say you buy a contract on Apple for $130 is the strike price on it. You don't have to worry about the strike, what that means. at the moment, but let's say you buy it whatever for the 130 per dollar price. Let's say it magically makes it all the way up to $200. Well, the contract gives you the ability in order to buy 100 shares at $130, even though it's at 200. So basically, you buy them at 130, and you can instantly sell if you wanted to at $200, and you basically make a profit in between. So it's $70 times 100. That's what, $7,000, and yeah, you could do that. And if you have multiple contracts, you could do that more. It's just a matter of having the capital in order to do that stuff. And then cryptos, again, like I mentioned earlier, each aims to solve a different purpose. Like some want to replace what the old ones are, which is Bitcoin, Ethereum. Ethereum has really high fees, so there's some cryptos like Solana that want to replace, not necessarily replace, but be competitors with Ethereum. They have cheaper fees for transactions. Their system's a lot faster, but they are more centralized, which kind of defeats the purpose of crypto, which aims to be decentralized. I swear, I'm sipping on energy drink, not that drink. So trust me, I'm burping because of that shit. But you know, there's different ways to actually make money in crypto. You can either use leverage trading, which ranges anywhere between like double your money. Basically, like if you put it in $50, it's actually worth 100 if it moves up, if it moves down or whatever. Or all the way to 100x, which is usually prohibited in most countries because for obvious reasons, you can definitely lose a whole bunch of money like that crazy. It's like gambling basically. Or you can do spot, which is basically like, I guess you say the shares of crypto. You're actually buying the coin. But there's also other interesting stuff and interesting topics that you have to look into. It's called mining, yield farming, staking, and each is different for each type of crypto, because some of them are proof of work, which is POW, or proof of stake, which is POS. And then NFTs, like I mentioned earlier, are basically digital art, and they only have one specific owner, and you can get verified that way. And for the higher value NFTs, basically from what I've heard, is that they actually have value to them. What they do is they kind of give you social status in the eyes of other people. So you might get invited to certain parties, certain investment meetings, different access to different shit. It just depends on the crypto. I mean, the NFT for different categories. And honestly, I don't know enough about them in order to kind of give you a big breakdown on the smaller ones. But like I mentioned earlier, I imagine they're like collectibles. People like them. You can actually use them on your phone for different shit. I know someone who actually used NFTs. And like the pictures they take and they post them, or the videos they take and they post that on Instagram. On Twitter, what they have is basically if you post an NFT as your profile pic, it'll show up I think a hexagon rather than a circle like most people. And again, I feel like NFTs are going to integrate into like our life, into our social status electronically, and basically kind of be a way to show off our wealth, if that makes sense. So some people might get a Louis bag, people might get some hyper royal Jordans or some rare Jordan 1s or whatever comes out on the sneakers app. Well, this is a way to do that as well. And they're actually dropping digital shoes as well, like Nike NFTs, which is pretty interesting. Something else to keep in mind is the time frames you have when you're trading. These terms are mainly due to stocks. I mean, mainly are for stocks, but some of them are used for crypto as well, such as scalping. I mean, you can read the slide itself, but basically in and out really quick. You're usually using leverage because you're only in there for a small amount of time, and you usually can't make that much money off of a small move unless you're using a giant amount of money, which unfortunately I don't have. But if you do, that's good for you. Day trading, name speaks for itself. Trades within a day. Swings, they could either be overnight or weeks long or even a month long. And once you start getting to past a month, they start considering it into long-term swings or even leaps. And leaps is with respect specifically to contracts. If your long-term swings, it could be for crypto or it could be for shares. But again, options, you use the term leaps when you have multiple months or even years on your contract. And yeah. Damn, I don't know if you can tell, but this is a lot of fucking talking. Sheesh. Let me catch my breath real quick. ASMR. So when it comes to being bullish or bearish in the market, basically if you're bullish, you're expecting it to go up. If you're bearish, you're expecting it to go down. And some ways that people use to describe what they are in the market is calls and longs whenever you're expecting it to go up, or puts and shorts. These are terms used specifically for whenever you're talking about contracts. But usually people will say, I bought calls today, or I bought puts today, if they're expecting it to go down. or I'm long on certain stock, they're expecting to go up, or I shorted such and such stock, which means they're expecting to go down. They're actually two different things, like calls and longs and puts and shorts, but usually people use them synonymously. Technical analysis, basically making predictions of certain stocks based off of what you've seen on the charts, which is past price action. The fundamental analysis is looking at different stuff about the company, the products they offer, as well as their growth. And then from there you decide, is it a good buy or is it a good sell at the time? If you have no position in it, like you have no shares or no contracts in the specific stock, but you see it's above value, then you wait for it to come back under value. And from there you start accumulating, or you just go all in at that point. Some other things to keep in mind is market hours. So for the stock market, the New York Stock Exchange in specific, and this is for stocks, not necessarily for Forex, because Forex you're worried about all the other time zones and all the other exchanges, like the London session, the New Zealand session, and the Japan session, I think it's what it is, or the China session. I forgot, Hong Kong exchange, I think it is. But anyways, if you're talking about just the New York Stock Exchange, which is what most people use when they're talking about stocks, there's something called pre-market and aftermarket hours. And basically it's pre-market from 4 a.m. to 9:30 p.m. a.m. Eastern Standard Time, all the way up until 3 p.m. Eastern Standard Time to 10 p.m. Eastern Standard Time is aftermarket, and you can only trade shares during this time. There's actually a specific time from 3 to 3:30 in which you can sell your contracts for options, but you can't buy anything. It's specifically for shares, and the trading hours is between the 9:30 a.m. up until 3 p.m. Eastern Standard Time. You can trade something called futures, like around the clock, 24/7. But it's not 24/7. It's 24/5, I guess you'd say. It opens up at 5 p.m. Eastern Standard Time on Sunday and closes at 10 p.m. Friday Eastern Standard Time as well. I don't know how to do that. Honestly, I think you have to have special access in order to trade futures. But like I said, I don't get into that shit. So it's more institutional money, by the way, too. So something else meant to mention is diamond hand versus paper hand. Basically, when you diamond hand something, it doesn't matter how down it is, like value, you still hold on to it with hopes of it coming up. Expect it to still go up so you don't sell. Paper hand is basically the opposite. If you see it go down really fast, you panic sell and you just get out of position. And usually people will use this for crypto, and specifically they'll use the term called hodl. So instead of hold, they'll use hodl or hodl, however you want to say it. And basically diamond handing for crypto, because I don't know if y'all know or not, but crypto's a hell of a lot more volatile than stocks are. So you'll see that port go down 50% at points, and you'll see it multiply by 3 at points. In time. Something called pricing in is basically there's bad news going to come out, such as I don't know if you've seen recently the stock market, interest rates are rising. What they do is they kind of price that in, so that's why the market's been going down lately, because they know that in March the interest rates are earliest March the interest rates are going to rise, which usually de-incentivizes investing. So it'll go down with anticipation for that to happen. So whenever it actually does, excuse me. So whenever it actually does happen, it won't change that much in price at that time because it's just already priced in. Each one has a unique one. It's called a ticker. I'll show you actually what a ticker is right now. So if we look up Starbucks right here, this is Starbucks' ticker, SBUXY. I have no clue, but that's what represents Starbucks. And then, even you can look at Apple as well. You can look up Apple, and you see his ticker is AAPL. If you want to look at the chart, that's what it looks like. And basically everything has their own pair. So even Bitcoin is BTC. But the thing is that since Bitcoin is considered a currency, you exchange your US dollar for Bitcoin. So you put BTC USD because US dollar. As you can see from right there, it says it right there. But what you basically do is the first half of it is what you're buying, and the second one is basically what currency you're using to buy it. So if we look at this Bitcoin chart, damn, my level's actually kind of holding up kind of nice there.
But basically, this is how much Bitcoin's worth in US dollars. So yeah, I'm actually expecting it to hit somewhere down here first before it ends up coming up. Got some limit orders set and shit. So that's hopefully gets there. But anyways, let's go back to the PowerPoint. That's what a ticker is. The last thing we're going to talk about is a brokerage versus exchange. So when you're buying stocks or you're trading Forex, you basically use a brokerage. They make their money through fees or spreads, depending on which one you're doing. And then exchanges is where you buy crypto. Technically, you can buy crypto on a brokerage like Robinhood, Webull, TD Ameritrade, but you're not actually buying the coin on there. You're just buying something that represents the coin and it tracks the price. So if it goes up by $1, your account in Webull or wherever you're at is going to go up $1 as well. But the thing is that you can't do anything else besides flipping it, basically playing it. With crypto, you can actually, like I spoke up on earlier, making money through yield farming, staking, mining. You can do a whole bunch of different stuff with your crypto, but you can only do that if you own the coin itself. They make their money in fees, which are actually tax deductible, so definitely keep that in mind. It brings your cost basis down. So we kind of looked, like I said, a mile wide, inch deep on a whole bunch of different things. We're gonna go more in depth on the things that we're specific to this channel, which is gonna be crypto, shares, and options. Stocks being the crypto, goddamn, I cannot talk. Shares and the options. Long-term money is definitely better than short-term money, so keep that in mind. That's why this first series, we're gonna be talking about long-term investing as well as retirement accounts, because at the end of the day, you can lose a lot of money short-term playing these leverage positions and shit like that, trying to day trade it, do these scalps and shit, which is honestly how I blew up my port. So don't make the same mistake as me. The other topics we're going to be talking about in the series are retirement accounts, dividends, shares/ETFs, and goals. First one's going to be goals that we're going to be talking about next. So basically, this next video is going to be talking about what to expect with long-term investing, mid-ish term investing, so like spot type trading, and then also leverage trading, like what you can expect to make out of it, what's your time frame, how involved do you have to be in it. Again, we're going to talk about that next video. So it's going to be it for today. Appreciate you guys for tuning in, and until then, peace.